Hi, this is Vijay Bhambwani and I'm back with you again in this video to talk about the markets. Do you have any questions about where the market is likely to be next week? What are the resistances and supports of the Nifty? And more importantly, learning along the way as to why I expect what to happen. So what will take the markets up? What can take them down? What are the triggers? If you know the cause, you can know how long the effect will last. So in this video, I attempt to basically give you levels as well as teach you how to interpret the market signals both at the same time. This is Vijay Bhambwani, your host. I bring along with me 35 years of trading experience. If at all you do like my videos, please don't forget to subscribe to my YouTube channel and help me get more and more people to get the message across. Let's dive right in. And the markets basically saw bullish action persist, and it was to a flying start in the calendar year 2021. As you can see on your screen in the market roundup, the Bank Nifty rose slightly more than the Nifty 50, and the bullion actually fell on a week-on-week basis, basically because of the steep decline on Friday itself. If you were to take away the declines in bullion on Friday, this could have been an entirely different picture altogether. And oil and gas rose, which is actually a worrisome development for the Indian markets, because we need a falling US dollar and B, lower oil and gas prices so as to control our inflation. So this is one red flag for the coming week which you need to make a note of. The dollar rose marginally against the rupee, and the 10-year benchmark bond yields fell to 5.89% as compared to 5.90% last week. And on your screen, as you can see, the market-wide position limits, the MWPL, rose because after expiry, there is a natural tendency of the traders to build up fresh long positions in expectation or anticipation of higher prices in the coming settlement. So this is along routine lines. And you can actually see on your screen now the chart of the turnover, where the stock futures turnover is up on a week-on-week basis, but the index futures turnover is actually down on a week-on-week basis. Now, as far as I'm concerned, it basically indicates the fact that risk appetite went up and people were actually being a lot more stock specific, and therefore they are expecting higher prices in the coming week on those counters. The basis chart shows both indices, the Nifty 50 and the Bank Nifty, saw continuous contraction, and the premium in the futures actually went down compared to the previous week as against the spot prices, because higher levels attracted selling pressure. Now the roundup done, let's go down to the 10-year benchmark bond yield, the bond markets. As I've said in my previous videos, this is a fountain of all money. You basically cannot trade the Bank Nifty or banking stocks without knowing where the bond markets are headed, because there is an extremely tight correlation between the bond market and the Bank Nifty and banking stocks by default. So the RBI announced new measures for reverse repos as well as intervention in the forex market. And the basically reverse repo and other measures announced by the government were to the extent of 2 lakh crores, which explains to you why they refused to buy any bonds a fortnight ago which were offered in the open market operations. Now this move of the RBI is expected to mop up certain amount of liquidity from the market. This is another red flag as far as I am concerned. So rising dollar, rising oil and natural gas prices, along with reduction in liquidity. That could be another factor to watch out for. And no matter what anybody tells you about bond yields not being correlated to equity, I think you should ignore such hazardous advice and pay attention to where the 10-year benchmark bond yield is headed. So in the coming week, keep your ears to the ground and watch where the 10-year benchmark yield along with the US dollar index is headed in order to basically guess as to where the markets overall are headed. Let's now go towards the US dollar index, the DXY. Now, this index rose on 3 out of 5 sessions and ended with minor gains of 0.18% on a week-on-week basis. The price is now headed towards the 25-period exponential moving average on the daily chart, which is overhead. And as and when the price overcomes the 25-period exponential moving average, bear covering can lift values even higher, the DXY even higher. But that is actually a negative for emerging markets, including India. So you need to watch this development extremely carefully in the coming week. The daily chart on your screen is making that amply clear. And I'm bringing up the weekly chart on your screen right now. The first thing that becomes immediately apparent is that the week gone by has made a bullish hammer, which basically indicates that the bears are resisting, the bulls, are resisting any further declines and are not allowing the index to go down easily. Last week, I advocated a range between 91.50 on the upside and 89.0 on the downside, which held perfectly along expected lines. And I expect the coming week to have an estimated, I'm emphasizing on the word estimated here, a range of 91.30 on the upside and 88.90 on the downside. Now, I again reiterate my view that you need to keep a keen eye on this index to know where the overall markets are headed. Let's now get towards the Bank Nifty, the second most liquid counter on the NSE, and as far as impact costs are concerned, the second best counter to trade. Now, this index actually outperformed the Nifty 50 in relative comparative terms, and it rose on 4 out of 5 trading sessions, ending with 2.75% gains on a week-on-week basis. What actually comes to my attention, the first thing that I see, the daily chart, as you can see on your screen, is that the rallies, at least the last few candles, were extremely small. Number 2, they have dark shaded bodies, which means net on a day-on-day basis, the index might have gained, but the closing was actually lower than the open. So the bulls managed to open the market with a gap up, but the bears managed to wrest back or fight back some control from the bulls by closing the index below the opening. Like I said, net there have been gains, but these are not really very great signs. So I'm mildly concerned with that. Also remember that I spoke about the dollar and oil and gold prices, oil and gas prices rising, So you need to keep an eye on the Bank Nifty in the coming week. And the RBI tweaking the repo, reverse repo, bond buying norms to the extent of 2 lakh crore is another thing that would weigh on the Bank Nifty, because it's tightly integrated with the bond market. And the index in the week before last was number 1 on the most volatile list, but last week it fell to number 5. Now do remember that the volatility on this index has not really come down. It's just that volatility in the stocks has risen faster than the Bank Nifty. They are two different things. So although the Bank Nifty is at number 5, it doesn't mean that its volatility has gone down significantly. It's just that stocks have become more volatile. Last week I advocated a range between 32,650 on the upside and 29,800 on the downside, which held perfectly. The next week we'll see an estimated, I stress upon the word estimated, range of 33,500 on the upside and 30,675 on the downside. As long as this index remains above its 25-day exponential moving average, I think the bulls are still in control. Do note how the three blue dashed trend lines, which I have drawn on the chart on your screen, are converging at the 28,800 level, which is likely to prove to be a major support if and when any decline occurs. So this is now an established support area which you need to watch out for. Let's now get to the most liquid counter out there, the Nifty, and I personally favor the Nifty, relatively speaking, in terms of impact costs, ease of ingress and egress, which is entry and exit. So I favor this over the Bank Nifty in relative comparative terms. Now the Nifty rose on 3 out of 5 trading sessions and gained 2.35% on a week-on-week basis. That makes it relatively underperform the Bank Nifty. But unlike the Bank Nifty, the rise was unambiguous and clear. As you can see on your screen, the candles are full-bodied candles and convincing ones at that. As long as the price remains above the 13,738 levels. Now this level will keep changing as the price progresses. At this point in time, 13,738 level is the present reading of the 25-day exponential moving average, and the bulls will remain in charge as long as the price remains above this mark. This level also coincides with the blue dashed bullish trend line, which you can see on your screen. So this is a very critical area of support you can watch out for in the coming few days or few weeks. In the week before last, the index was number 5 on the most volatile list, but last week it fell to number 13. Now here again, I state that it's not that the volatility of the Nifty has gone down, but it's just that stocks have become a tad more volatile than the Nifty itself. Then last week I advocated a range between 14,425 on the upside and 13,600 on the downside, which held beautifully well. And coming week, I expect an estimated, I stress upon the word estimated, range of 14,750 on the upside and 13,925 on the downside. Now, in terms of impact costs, liquidity and ease of trade, I think this index is number 1 within the F&O space, definitely higher than the Bank Nifty in comparison. Also note that we are 3 weeks away from the Union budget, and trader expectations are likely to lend higher volatility to the prices, because traders are now building up positions, second guessing and estimating the budget proposals, etc. So you need to be extra careful out there, and higher volatility can cut you both ways. So let's prune our trading positions and trade on smaller exposure levels out there. Coming up now is the most popular segment of this video, wherein I give you 5 stocks to trade which are high in beta and high in impetus, which means you take small exposure and get bigger price moves. And 5 stocks in the low beta and low impetus segment, wherein you take large exposure and wait for very small price moves before you can flip the trade over. Now the high beta list is led by Power Grid at number 1. Number 2 is Bharat Forge. Number 3, LIC Housing. Number 4, IDFC First Bank. Number 5, Havells. And low beta stocks, number 1, Cipla. Number 2, HDFC Bank. Number 3, Indigo. Number 4, Cadila Healthcare. Number 5, Titan. Friends, do remember that this list is dynamic, and as price action changes from day to day, this list can basically get reshuffled. As we speak, based on Friday's data, this is how these stocks are stacking up. Coming up on your screen are my contact coordinates. I would love it if you keep in touch with me on social media. We can get conversations going, exchange ideas, and I put in a lot of statistical data and market related data on my social media pages. I would love it if you read them post-market late evening and become better at understanding the signals of the market. It's all in very simple layman terms. You'll find it fairly interesting. So I bid goodbye to you in this video, and I hope you're going to subscribe to my channel. Click like on this video if you agree with what you saw. Click on the bell icon so you can receive instant alerts of any videos being uploaded out here. The comment section is open to you for letting me know what you think of this video, and help me spread the word of knowledge-based investments and trades by referring my video to your family and friends. Do take very good care of your trades and investment. I wish you very, very profitable week ahead. Vijay Bhambwani signing off for now. Thank you for watching me. Take care. Bye-bye.